Hey everyone, hope you are having a great Friday. I apologize, I'm losing my voice a little bit. So I think there's something about having a germ factory in the house with a 3-year-old that is just kind of constant. So I'm sure a bunch of you know exactly what I'm talking about. So next week, we're going to be talking about how to double your portfolio every 2 to 6 years. This is where we're going to tell you how to get started and how we do our model, how it's going to help propel your wealth forward. A lot of what I'm going to talk about today is what our model is and how we utilize it. But this is more looking at how that's going to look long term and how we physically make it happen. What does it look like to buy the property? What is the duration of ownership? How is that managed during that period of time? What happens when it's time to sell? Do we cash out? Do we 1031? What does that look like? So it's basically going to be covering the life cycle of a property. So today I'm going to talk to you about how we use leveraging to make it all come together. But what we're going to talk about next week is the entire process and what that looks like for you, what you need to be doing to monitor that, how you work with our team to make that happen, and really how we grow your wealth. And so that'll be next week. This will be another hour one. So today is going to be about an hour. And then this one is going to be another longer one. So anticipate about an hour. As a reminder, you can always register and get a link on the back end to go rewatch. And then, of course, it gets posted to all of our channels as well. For those of you that have not yet RSVP'd, both of these topics and a lot more are going to be covered at our conference, not next weekend, but the weekend after. That is a free conference on Friday, and that's from 10 to 5. We do have an after party that evening and a couple other things I'm going to go over with you in a moment, but I do want to reiterate this is not being recorded. And so if you want to come to the full event and learn about everything we do and hear from the other experts, that's something that happens in person, and that event is free. So that'll be in McKinney on the 14th. And then that evening, we have our after party. We've got an awesome time for everybody. We've got a live band coming. We have great dinner and then tons of people coming, both experts and investors to mix and mingle with, of course, Michael and I. We do have a special running for the next 24 hours. It's 25% off the entire event right before we close sales. And so you can use the code MASTERMIND to get that 25% discount. So that dinner party will be at the hotel at the Sheraton McKinney from 5 to 8 on Friday. On Saturday, we'll be doing our bus tour again, 25% off before we close out for that. Also code MASTERMIND. We'll be going to both Grayson County and Hunt County. We may even stop up to our development in Oklahoma right over the border, just depending on time. So we'll let you guys know that the morning of. And then finally, we have just a couple slots left at our Sunday Mastermind. We'd love to see you there. 25% off that as well. There's a one price for a single and then a discounted price for a couple. And that can be you and a friend. It doesn't have to be a romantic couple, but that will take place at my personal home. We'll be taking a look at the ranch that we're building, looking at what my journey's been, talking with each other on what your journey is, what your goals are. And then included as part of that mastermind, you also get a 30-minute strategy session with our intake forms with me and Michael, going over your portfolio, what your goals are, what you currently own, all those different things to help guide you on your journey. And that's included for free with the mastermind. And that's something that I typically charge $500 for. So it's pretty good value. Again, this is limited to 12 people. We've only got a couple slots left, but that is 25% off code mastermind. You can go to the Eventbrite, you can scan the QR codes or any of the marketing blasts that you're getting to get to that link. Again, the event on Friday is free though. For those of you that are new to us, again, as always, I'm not going to go too deep into who we are. Just know a few things. I own a lot of real estate. I own and operate multiple companies in the real estate world. I have been in this business since I was 18. It's quite literally all I've ever done. Our model's unique. We bring all this free education to you to teach you not only how we did it, but how we did it as normal people. You know, we weren't someone who grew up with this, where our parents had massive portfolios and it was handed to us. We built this as our individual selves with really developing this model going into the last crash. You know, we got into the market February of 06 and our history is pretty crazy. A lot of people don't realize we were doing flat fee listings back when no one knew what they were. We were doing BPOs, broker price opinions for Countrywide and AmeriQuest before they imploded, and working with property management and investors along the George Bush expansion here in North Texas before anyone even knew it was happening. So our career has been very interesting, but it really gave us foresight to see what was happening before the crash. And so we built our model around being resilient regardless of what the market's doing. So that's a conversation for another day. We actually, we have a book that's going to be coming out going over our whole journey, not just our investment investment journey, but also our personal adoption journey and a lot of other things with what we've done. So I'm not going to take time on that today, but just know I have a little bit of a clue what I'm talking about. Of course, you can go to our website and see all of our investor education. Again, this is always free. Tons of our investor resources, see upcoming events, watch previous webinars and classes, and always go over to our Twitter, Facebook, Instagram, or YouTube. We also have podcast channels. And if you ever have any questions on any of the content, or if you have an idea for other content, please send those over. A lot of my class segments that I do are based on feedback and questions from our clients. And so if you have a topic you want me to cover, if you have something that you feel like you need more understanding of, reach out, let us know. And that's something that we can incorporate into the webinars coming up. We're in our summer series right now. Those of you that have been with me for years, you know that we do a lot of education all through prime season. So we're weekly right now. And as long as I don't wind up sick with no voice, we'll keep doing that. Before I get started, everything we're going to talk about today is my best judgment based on years of owning and operating a real estate firm, property management endeavor, and as a real estate investor myself. Of course, I believe that the model that we follow and how we do our own investment operations is the right model, but that doesn't mean it's the right model for you. We are one tool in your toolbox, and I always recommend that you consult with other experts, follow other people's guidance, read, listen, watch. There are so many of us out there doing this journey, and just because the journey works for me this way doesn't mean that's the best option for you. We are one piece of that puzzle for you, and we always want to connect you with other people who can help guide you on your journey. That said, always do your due diligence. We don't have crystal balls. We can use our guidance and knowledge and all of our experience to make predictions and recommendations and build a model around it. But of course, markets can change. All investments can be subject to risk. Of course, I believe it is the safest investment you can make in this life. And I certainly have put my money where my mouth is, but everyone has a unique situation. And so do make sure you're doing your due diligence, not just on where you're buying or where you're operating, also who you're operating with and what model you're operating under. All right, so let's get started. Why do we do all this? And I'm going to take a little bit different approach today. I talk a lot about our 2 to 6 year model. What we're going to do today is connect those dots. Why is this so important? Why do we need to be leveraging? Because at the end of the day, the goal that I want you to take away today is that there is no way to do this without leveraging. There is none, certainly not in our lifetime. And so one of the things that I think about a lot is what happens in retirement. And this is really personal to me because I've been raised in an environment where nobody really prepared for retirement. You know, a lot of you don't know that Michael came from a very, very limited upbringing without money. And I came from a family that had a lot of money that lost it. And so he was raised with none, and I was raised in a family reminiscing over what they once had long before I was born. And so we grew up day one thinking, well, how are we going to provide? How are we going to survive? And in a world that really was telling us that the government wasn't going to take care of us. And so, you know, one of the things about starting this young and starting when we did is there was a lot of negative in the air, a lot of negative discussion. And so everything that we have done has been around this idea of how are we going to pay for retirement? How are we not going to work until we die? Because so many Americans, that's what they do. I mean, I go to Walmart to go shop or Target, and there are people in their 90s still working there. Now, are some of them doing it because they want to? Absolutely. Or is it because there is not a setup right now for someone to retire in an inflammatory environment like what we're in right now? So let's talk about that. We're inflammatory because inflation is so high. Costs are rising. It's also because it's impossible to find an affordable place to live. The cost of living has gone up. This is not just inflation. This is just natural increase of what it takes to live today. 50 years ago, we were all fine without cell phones. I don't even know what it would feel like not to have one on my hip, knowing that my kids could reach me. We live in different times. We live in a different world. And what it is to survive today is so different than what it was before. We can't wait for a delivery of a milkman to our front door and live on limited foods, right? This is not how we're raised. Just the sheer cost of living has gone up. So 1 in every 4 65-year-olds today will live past age 90. How many 35-year-olds? I'm 35. How many 35-year-olds do you think are going to live past 90 by the time I'm at retirement age? Are you prepared? Is your plan going to give you 30 years of retirement? 9 times out of 10, maybe 90 out of 100, maybe 99 out of 100, the answer is going to be no. Everything that we do is built around growing a portfolio as quickly as possible. And this is different for everybody, right? For some people, it's retirement. A lot of our clients come to us in their 60s and 70s. I have some new clients we just brought on in the last few months that are in their 80s. I have one of my investors I could think of right off the top of my head that's been with me for almost 15 years, and he's been 90s. This is not a game to just do at one point in your life. This is something that you are doing to prepare and set up for the future. But some of us are doing it to replace an income. Maybe you want to not be in whatever job, whatever W-2 you're in, you want to replace that. Some people it's to supplement it. Well, I want to be able to travel and do the things that I couldn't do with my family because they didn't have that money. Everyone has different goals, but the end result is the same. You want to make as much as you can. And if we take it slow, if we take it in that type of route without leveraging, you're never going to get to the point you want to get to unless you're starting with a massive, massive nest egg. Nothing frustrates me more than watching a guru out there who inherited $5 or $10 million talking about how they've amassed this massive portfolio. But what they neglect to tell you is they had this inheritance. They had this 401k. They had a lot of money to start with. We all know it takes money to make money. The rich get richer. Our model and what we do is built around the everyday person. It's built around whether you're making $200,000 a year or whether you're making $50,000 a year. It's about wherever you are, getting you in a growth pattern as quickly as possible so that you can do whatever it is with that money that you want to do, replace an income, supplement an income, retire, whatever that may be. So step one is always going to be acquiring a property with max leveraging. This is what we're going to talk about today. We talked last week about step 2, 1031 exchanges and selling that property or cashing out during years 2 to 6. Next week, we're going to look at how this whole process comes together. And then step 3, of course, is buying new property 2 for 1. Some of us do 3 for 1. If you're me, you do 28 for 1. It just depends on where you are in your investment journey. But the model doesn't change, guys. The life cycle stays the same forever. And they just repeat it over and over and over and over, just at larger scales. So we buy a property, and then we get our monthly cash flow. Property appreciates, principal pays down, we sell the property, or we cash out exchange and we go do it again. And you're going to do this over and over and over and over. And the goal is defer, defer, defer until you die. And then when you die, the basis resets. And then all of your assets that are inherited start over for a new generation to follow the same life cycle. Again, it doesn't matter where you are in your journey, whether you already own 10 houses before you met me, or whether you've bought 10 houses with me, whether you're just buying your first one. The cycle is the same. Even me with 40 million in real estate, the cycle is the same. That's the model. Wealth from real estate is truly boiled down to 2 different ways we make money. Number 1 is cash flow, monthly cash flow. And number 2 is appreciation over time. It's paramount that you are in a market that offers both. I cannot say that enough. There are so many markets that look like they have cash flow, but they do not appreciate. And I will tell you, most of the time, those markets are not landlord friendly, and that's why they don't appreciate. They're not business friendly. That's why they don't appreciate. You need to be in a market that is as safe as possible to give you both of these ways to make money. But we've got dual returns on the cash flow side, right? Because you've got your monthly cash flow, and then you've also got someone else paying down your mortgage. Just the principal pay down on a regular rental and the price point we operate in is about a 5% return a year. So right there, this is foreshadowing what we're going to talk about as to why it's so important you don't own properties in cash. I did a consult with someone this morning who's following the model. They've bought 2 properties with us in Grayson County. They're doing exactly what we said, except they paid cash. So one of the things we talked about this morning is how instead of having 2 properties, this person should have 10. And how with 10, then we turn it into 20 and 20 into 40 and so on and so on. And that is the life cycle of what our model offers. And depreciation is often one of the biggest pieces of it, because in the right market and housing climate, it can match or exceed your cash flow, especially with our model. Those of us that owned property the last 3-4 years, we've seen a 35% increase. It is all about the market, the model, the team, whether it's me, whether it's someone else, whether it's North Texas, whether it's Florida. Make sure you do your research on the hyper-local area. And if you've been listening to me, we've been really fixating on this right now because now it's more important than ever. So then that leads into the question, well, how do we pick a property with the best potential to appreciate? And these are all the things that we talk about, right? Buying an area with a housing shortage, huge, supply and demand, simple. Target areas with the highest job to population ratio, areas like my top market, Grayson County. Buy within 5 minutes of a major highway, naturally going to grow. Target areas that have multiple options to access highways. All the areas that we work in, it's not just one highway that feeds. It's not just one way that you can get there, keeps traffic patterns down, but it also allows multiple opportunities for growth. And then buy in areas with suburbs with less than 100,000 residents. We don't want to buy in the middle of Dallas or the middle of Plano. That's not where the market's going to have crazy growth. They've already grown. You might see price growth and you might see some development, of course, but we're looking at percentage gain in entry-level housing while still having a great rent to price ratio. Not going to find that in those areas. But it's not just about the two ways you make money every month. It's not just about the appreciation and the cash flow. There's so many more benefits than just the monthly cash flow, right? It's an investment that helps you reduce the tax liability that we have as Americans. We can defer gains with 1031 exchanges. We can depreciate and cost segregate. We can take a mortgage interest deduction. We get property tax deductions. We can hopefully become a real estate professional and have all the benefits that go along with that. But then we also can claim lots of expenses. It's really every benefit that I can think of that has to do with real estate gets it to a point where I can't think of another investment that allows you to have so many different ways to not only make money, but also have insulation and protection. The big hype right now is inflation, the target of 2 to 3%. Well, we all know that's not going to happen. It's just not going to happen. It's not sustainable. And if we look at one of the things I talked on my call about this morning is what's happening in the world right now in our push away from Russia and China and imports. The more that we do this and the more that we have volatility, the more that the price of goods are going to go up and the more that there's going to be a push to make them here. Inflation, 2 to 3% is unreasonable. There is going to be a new normal with inflation, and I anticipate it's probably going to be 4 to 5%, maybe even as high as 5.5 or 6. That is where we're going to get back to. And that's when they're finally going to stop raising rates. They're going to go up a little more, y'all. We're heading into an election year. Prepare for volatility. If you've been following me for years, I talk about this every election cycle. This is what happens. But the benefit of real estate, it's the best tool to hedge against inflation, because the more that the value of the dollar goes down, the more the value of homes goes up. Just look at the charting here. It's almost polar opposites. Cash in the bank loses value. If you're stockpiling cash, have a little bit. I don't disagree with that, but it's doing you no good. Unless you have so much cash you don't need to use it anymore, you need to be investing. Owning your home outright, owning your rentals outright, you're losing so much money. Right now, we are still at a point where we can make more money on our investments than what it costs to borrow to buy them. What other thing can you do that with? And then, unlike stocks, you have complete control. What you do with it, where you buy, what model you buy in, what type of property you buy, what you pay, what type of lending you do. You control everything. The goal is to have as many properties as you can to be able to take advantage of these maximum benefits of real estate. And leveraging is not a tool for those just getting started. It's not just for people that are starting out. It's not just for people that aren't rich. In fact, the rich use leveraging more than anyone. Even the top 1%, our wealthiest billionaires and millionaires in the US, they leverage their assets to buy new investments. That's how wealth multiplies. And the wealthy understand that. They use their wealth to get wealthier. Leveraging against your assets by borrowing money and then using that same money to buy an asset that brings in more money than the cost you spent to borrow it, that's how you grow wealth, both income and assets. And that's also how we have assets that reduce the taxes you owe and pay. The wealthy understand that. And this is one of the biggest places that people have a hard time getting started, because they'll follow the model. They'll do the right thing. They'll buy the homes, and then they sit and they sit and they sit. And your return gets worse and worse and worse. But more importantly, you could be doing so much more with that same amount of money. Leveraging allows you to buy 4 to 5 as many properties as when you pay cash. For example, we start with $200,000. Each property, assuming 25% down, you put $50,000 in each property, and these are $200,000 homes. You've taken your $200,000 and you've turned it into $800,000 in assets, $800,000 in property that are working for you, appreciating for you, cash flowing for you, depreciating for you. All the things that we talk about to grow immense wealth. Now imagine the power of that doubling following the model. You start with 1, you turn it into 2, you turn it into 4, you turn it into 8. That's the power of the model. That's the power of leveraging. That's the power of buying in a market that is sustainable for both cash flow and long-term appreciation. There's no doubt that leveraging is the best tool to grow your rental portfolio. We've already talked about that every property gives you more than just cash flow. We get tax reduction benefits. You're paying down principal of about 5% a year in profit. And hopefully we're appreciating. As you leverage, your return increases on each of those benefits. You can grow your portfolio 4 to 5 times as large for the same amount of initial capital. Think of each property as a team member. I talk about this a lot. The more you have, the more to split the work, the more to split the risk, and the more worker growth you can accomplish. With each property, your worth and lendability increases because what it does is it establishes you as an experienced investor. It opens doors for you for better lending and better opportunities, better models, better access. I didn't start out buying 50 or 100 properties a year. I started out with 4, 6.5 years ago, 3 of which were brand new. There's no doubt that leveraging helps you grow your portfolio, but the benefits are more than just that, y'all. It's the greatest hedge against inflation because you have more properties protecting you. You have much higher cash on cash returns and more cash flow. You have a higher overall global return due to appreciation and 4 to 5 times the number of assets doing that cash flow and appreciating. You're going to have higher occupancy because you don't just have 1 or 2 properties that may or may not be vacant for turnovers. You're spreading that risk. Lendability benefits, access to better programs, lower cash output to purchase a property. You're earning money, borrowing a bank's money. They're literally paying you to go make money. And of course, the financial exposure per property decreases. This is the power and the benefit of using leveraging. So let's recap. 4 to 5 times the tax benefits. And remember that depreciates on the value of the actual property, not equity. So by buying one property versus leveraging into 4 to 5, it's not like you're depreciating the same value. It doesn't work that way. 5 times the assets, 4 if you're doing 25% down. Higher cash on cash return, higher cash flow. But most importantly, risk diversification. You're spreading your risk and exposure across multiple assets. Other than real estate, what other assets can you leverage against to buy more? What other investment offers you all of these leveraging opportunities, all of these protective opportunities, all of these income opportunities, all of these tax savings opportunities? But let's look at the numbers. How does the return actually change on a cash on cash purchase when we're looking at cash versus leveraged? So let's start with looking at a cash purchase and a financed purchase. So on the left, this is if we bought a $220,000 home in cash, okay? And this is apples to apples. So on the left, we see that our cash on cash returns about 6.24%. You finance it, your cash on cash is 5.44. However, when we look at our entire return with principal payment, it's 11.34%. So the cash flow increase for sale cash output, look at the difference here. Because what happens is instead of having 1 property, we have 5. It's 81, more than 81% more cash flow. We have a lower cash on cash return. But more importantly, our entire return goes up 5.1%. This is where you make the mistake of thinking cash is better. There are tons of different types of loans that help you build a portfolio. This is not just you leverage up front and then you're done and then you have to go to cash. So let's talk for a minute about how we make these numbers possible. Right now, gold standard is Fannie Mae, gold standard. It used to be that Fannie Mae was a little more difficult and a little less desirable in my opinion because you couldn't transfer it to your LLC without a due on sale clause, but laws have changed, things have changed. When it comes to the cheapest money and the best amortization, Fannie Mae's it, y'all, that's 30-year fixed. But in reality, any loan that you go into right now, you're not going to be keeping long-term. You're going to be changing it out once rates drop. Again, we go back to date the rate, marry the home. A 1 to 4 family in decent condition is what we're looking for. New construction, already renovated, good looking homes. If it needs a brand new roof and there's leaks everywhere, if it has foundation problems, that's not going to qualify for Fannie Mae. So if you're doing renovation properties, this is not for you, at least not on the front end. 10 doors is your limit, but what that really means is 10 parcels or tax IDs, and that includes your personal home typically, depending on the type of loan you have. However, it's possible you, and if you're married, your spouse might qualify individually. All depends on your income, your debt to income, all of those factors. Fannie Mae is a 30-year amortizing, meaning the payment is spread over a 30-year term and a 30-year fixed period. So when you hear amortization, that's how many years the principal pay down is spread out over. One of the things that we see in alternative lending is 25-year amortizations, and I'm going to show you how that looks different in a moment. Fannie Mae for a single family, you're typically going to do 20% down. Right now, you might do 25% down to get a little bit better rate. And for 2 to 4 family, it's going to be 25% minimum. This goes in your personal name. Again, sometimes spouses can qualify individually. There's more paperwork, no prepayment penalty, low loan closing costs, and the cash out maximum if you cash out into a Fannie Mae is 75%. Fannie Mae is usually best when you're starting out because of the amortization and because of the rate benefits. So unless you're at a large scale and you're past Fannie Mae, my advice to you is going to be continue using Fannie Mae until you can't. Other lending, portfolio lending, debt service coverage ratio, DSCR, blanket loans, direct bank financing, etc. Now, this is not limited to 1 to 4 family. It's not limited to perfect condition. There are so many different types of loans when we get into the other lending options, and I have used pretty much every one of them. So if this is the point you're at or this is what you're interested in, that's when you need to talk to my team. Talk about what your goals are, do those things so that we can guide you to the right contacts. The terms vary. Usually it's a 25-year amortization, 5-year fixed period, and a 5-year balloon, or 5-year fixed period and immediate balloon where you have to go refinance. Sometimes we can find a 30-year fixed, especially on DSCR. Starts at 20% down, so that's nice. Loan to cost options, sometimes when you get further along in your journey and you're buying renovation property, you can use equity as down payment up to a percentage of the overall cost. Typically loan to cost we see at 90%, 85%, somewhere in there. So potentially as you grow on your investment journey and you start doing the model that I've done all these years now that we've gotten to that point, is you're not having to bring 20% down on every deal, or 25, wherever you are. Personal or business name, trust, etc. One of the things we're going to be focusing on at our event is how to title and the negatives of trust. People think trusts are a lot safer, and we have an attorney coming that's going to be talking to you about some of the risks with that and why we don't recommend that. I also, there's a lot of problems that can present with 1031s and sales and property taxes. I had a client call me about a nightmare situation in Florida by transferring things into a trust and a lot of other things that made that a lot more difficult and a lot more expensive. So make sure you're doing your research. Don't just go listen to one person and go follow that model, because that can bite you. A lot less paperwork for these other lending avenues than what there is for Fannie Mae. However, if you have a regular job, a regular W-2, consistent employment, I wouldn't be afraid of Fannie Mae, especially not the lenders that we work with. They're fantastic and super easy. Sometimes there's a prepayment penalty, especially on a DSCR loan, and often there is a coverage ratio, meaning that the mortgage payment and what the income are, there's a requirement as to what percentage of cost that rent actually is. It could be 1.1%, it could be 1.25. I've seen some crazy bad programs where people have brought it to me and it's 1.5. Don't ever do that. So again, if you're looking at one of these programs, I'm happy to chat with you about it. I'm not a lender, I can't give you lending advice, but I can talk to you investor to investor of what I've seen and what I've done. Varying loan closing costs, make sure you pay attention to fees. Some of these companies charge astronomical fees, but they offer a better rate. Not worth it, especially not right now. Now, when rates were at 4.25, we were paying a little fees to get down in the 3s or down to 4. That made sense because you were going to sit in that loan until you die or until it pays off. But again, it all depends on what the market is doing. And then again, the benefit of other lending is it preserves Fannie Mae slots if you're using them. A lot of us do blanket loans or portfolio loans on the back end to reopen Fannie slots. And so there's a lot of tools that can happen to that when you get to that 10-door process. Now, there's a role of interest only in ARM mortgages here. And interest only meaning that you're only paying interest every month. You're not paying down principal, so your payment's a lot lower. And then ARM is an adjustable rate mortgage, which right now makes a lot of sense because none of us are going to be sitting in these loans by the time they adjust on a 5-year adjustment. So both are a great tool in a higher rate climate. There's a high likelihood of refinance anyway to improve the terms as the rate climate continues to improve. Rates are down right now from where they were in November, but they're going to stay pretty volatile for probably the next 6 to 9 months. If you don't follow my colleague Daniel Munoz on Facebook, I strongly recommend you do. He's giving updates every day and recommendations based on locking, what the market's doing. He's a guru. He speaks at my events, very, very knowledgeable in what's happening in the rate climate and also reading and interpreting what's coming. And so I definitely recommend, again, that's Daniel Munoz, or you can send me an email. I can send you his info. For an ARM mortgage, so that's an adjustable rate mortgage, that increases the cash flow because of the lower interest rate. So if you're not doing Fannie Mae, most commercial are not 30-year fixed anyway, and so an ARM mortgage really makes sense in a climate like what we're in right now. And then an interest only does a great job of increasing cash flow due to no principal payment, but it makes the most sense in a stable and appreciating market. If you're in a market where there's potential value loss, I would never recommend an interest only loan. So in a low rate climate, I strongly recommend to refinance all properties to a low interest rate DSCR financing into bulk loans to reopen back up your spots. But we're not in a low rate climate right now. And so right now, DSCR just doesn't make sense. It's a little more expensive to do those loans, and that's a refinance, not an upfront purchase type product. And so we'll be back to a DSCR climate sometime in the next year or two. I'll tell you when that is, so don't worry. Now let's take a look at what the difference between a 25-year AM and a 30-year AM is. Again, apples to apples. So when we look at a 25-year AM versus this 30-year AM, what you're going to see is a cash flow increase of over $84 a month on this one home. So that's 73% more cash flow. And then the cash on cash return is 2.29% higher. Now the overall global return is the same, because remember, all you're doing is paying down principal faster. So you're still making the same amount every month, it's just paying down into your principal. But those of you that follow me, you already know where I'm going with this, is that the more money or equity you have in a deal, the lower your return. And that's why you see this cash on cash return drop. So until you are maxed out or out of 30-year options, stick with 30-year options. Now, what about interest only loans to increase cash flow? Let's compare that. So on the left, you're going to see interest only, and on the right, you're going to see a 30-year with P&I, and that's principal and interest. So that's a regular amortizing Fannie Mae product. The difference is cash flow of about $211 more a month. That's massive. So essentially what you would have been paying to principal instead is coming to you in cash flow every month. So your cash flow increase is about 106%. The cash on cash return is about 5.77% higher. Now remember, the overall global return is about the same. The question is, are you paying that into principal, or are you getting it in cash flow every month? So that is the power of an interest only loan, especially if cash flow is what you're going for. Now let's touch on a topic we've talked about a lot lately. Why is it so important to refinance or 1031 and rebuy back into new properties at 75 to 80% loan to value? So here's an example property. Again, we're going apples to apples here. So this is a $220,000 property, same rent rate. Our return going in is 5.44%, globally 11.34, including that principal pay down, which again is about 5%. After this property is appreciated, and essentially what I've done is I've tacked a 25% increase on. So the value's gone up 25%. We're assuming the insurance and taxes have also gone up at 25%, but generally it's actually probably going to go up more than that because the taxes were probably discounted to start with, but we're going to keep it real simple here. So now your return, so let's go back, we were at 5.44 and 11.34. Now we're at 3.34 and 6.2. So you've lost a total return of 5.14%. Pretty crazy. Now imagine if you owned this in cash, because we've already established that you almost cut your return in half owning in cash versus leveraging. This is a leveraged difference just with 25% appreciation. So all of you that sat in properties the last 3 years and haven't dealt with all that equity, this is what you look like right now. So how does the return compare when you take that one property and you leverage into two instead? So here we go. 220,000 times 2. We've gone back into the same type of property we entered at. Our return's now gone up to 10.88% cash on cash and 21.76 with principal pay down. That's before all the extra benefits, the depreciation, net worth increase, the reduced tax period that you're probably going to have in the beginning, again, if you're following our new construction model. That's double, y'all. This is why you should maximize leveraging and why you should cash out our 1031 exchange following our model. The numbers speak for themselves. Imagine again the power of this doubling every 2 to 6 years with that same initial cash investment. And imagine if you had more cash to put in as you've saved up more, what the power of that would be. That is the power of leveraging. Now, if you want to go over your portfolio, as I mentioned, we do offer consultation calls. These are directly with me. You can always call the team and consult with them. But if you're wanting to schedule a consult with me, you can either email us at Slaughter Investing, or you can use the QR code here, or you all have my personal emails as well. You're welcome to contact me. Again, as a reminder, we're going to be going over the entire process in a lot more detail of all this at our free event on April 14th. Again, make sure you use that code MASTERMIND for the discount that's going on just through the weekend. And again, the dinner party will be Friday night from 5 to 8 at the Sheraton in McKinney. The bus tour will be on Saturday the 15th from 10 to 5. We have tons of amazing properties coming up. I'm going to show you a few of those in a moment. And then, of course, the Sunday Mastermind right now is 25% off for the last couple spots. This will end tomorrow. So if you're interested, reach out. You can go to the QR code or you can go to the Eventbrite. We'll be sending a flyer out after this with a link as well. Again, we encourage you to stay connected with all of our events and education. You can go Instagram, Facebook, YouTube, Twitter, any of the podcast channels. If you're not on my personal Facebook, you're welcome to send me a friend request there as well. We journey all of our rehabs, market data, more personal. I do my own Facebook. No one does it for me. And so you'll get to see a lot of personally what we're doing on our own investment journey, as well as keep up to date on our investment fund and our other new construction opportunities. So I want to take a few minutes. Those of you that want to hop off, please feel free. You know, I end all of these with available inventory and a little bit of extra education. So I want to go through a moment of what different types of investing there is, because a lot of the questions that I'm getting right now is what is the difference between passive investing and active investing? And so I want to talk about this for just a moment, and then we'll go into what opportunities we have today. So when we passively invest, this is where you are hands off. This is where you're not using your credit, you're not having to fill out loan paperwork, you're not having to go sign closing documents. You are investing along with a group of people. So this is like our real estate investment fund that we have right now, buying these renovation properties like what I do personally. So you put your money in and you receive distributions and updates. On our fund, it's quarterly. Other funds may have different intervals. So there's something called a PPM, or the private placement memorandum, and that's what you're going to read. That's going to give you the details of whatever fund you're investing in. But there's more than just funds. There's syndications, there's partnerships, there's lots of different ways to invest. Some are more passive than others. Some involve more risk than others. Development is one I'm strongly against. I don't believe in, certainly right now. And a lot of the people that are putting deals together right now are having to do development because that's really the only place the number works. We are blessed enough to have our teams and our rehab teams where we can offer a passive opportunity right now in the stable single family market of these growing areas, because I've already been doing it for myself. And so by investing in our fund, you're investing in the same model I've been using to amass my wealth all these years. Most passive investing opportunities are not in single family. So they're more multifamily, apartments, commercial, which of course, those of you that follow me, you know I hate all of those investment vehicles. I'm not a huge fan. But again, this goes back to everyone has their own model of what works for them and what doesn't. The things I like about passive investing is that you don't have to do anything. Once you do your initial paperwork and send your money, you just get paid and you get updates. So that's nice. The negatives are you have limited control and virtually no involvement. That can be a positive or a negative. It just depends on who you are. You get lots of updates, lots of information. And if you're with me, you know we're sending out tons of updates and giving these almost weekly. But again, it just depends on who you're investing with and what type of model you're investing in. I love about passive investing that you can often diversify across assets. So instead of buying one home or two homes, you're investing in 20 homes or 40 homes or 60 homes. And so that risk is spread, and so is the geographic location, even within a strong market like North Texas. Your investment is a liquid. So it's not like you can go in on a Monday and 4 months later call and say you want your money back. It doesn't work that way. So you're in it until it sells or until capital is returned with refinances. And again, that goes back to the PPM. What is the model that passive investment is following? And each one's different. Every model is different. So it just depends. Another benefit of passive investing is your credit's not used. You're not doing any loans in your name. You're not doing any loan applications. You're not having to put money down on loans. You're not having to guarantee loans. You're just in a deal and you're getting paid. Now, there's also lots of benefits to active investing. Of course, you own your property 100%, which means that you can control everything you do with it. The nice thing about a model like ours, and there's many people that work like we do with the OmniKey side, is that because everything's under one roof, because everything is kind of integrated, you still have a low level of involvement after the initial purchase, as long as you're in a professional management company where they have the different facets to handle things. Benefit is you can exit at any time. Of course, that's assuming that it's an exitable situation, but you can have control over what you do with it. You do have to use your own credit for financing. So anytime that you're releasing or you're refinancing or you're selling, it's all your involvement. No one's doing that for you. There are people like me that are going to handhold you and my team's going to handhold you, but you are still making those decisions and deciding what you want to do and what the best path is. So one of the questions I'm getting a lot right now is, well, which path do I take? And the answer is you have to make that decision. A lot of our investors are taking both paths. They're doing some passive and some active. But sometimes it's also about, are you an accredited investor? Because most funds, most situations right now, they're only doing accredited investors, which has some criteria. So I'll go over that in a moment. But my recommendation to you is this. You can diversify across types of investments, location of investments, model of investments, number of properties. There's so many ways to diversify even within one geographic location. So say that you're only comfortable investing in North Texas and maybe Florida, or maybe you want to go to Nevada. There's a lot of places out there. You can also diversify within the same area. And I think that's something that a lot of people don't think about. So the question becomes, which one works for you? Which one do you want to do? It might be both. That might be, I invested in our fund, I invest actively, I do all sorts of things. But at the end of the day, they all follow the same model. And that, I think, is the key takeaway here. Follow the model that works and find ways to work within that model that works. There are tax benefits to both. There are cash flow benefits to both. There are appreciation benefits to both. There are risks with both. There are positives and negatives of every investment vehicle. It's about what works right for you. So let's talk about what we have right now. So talking about our fund, and I want to focus for a moment on what an accredited investor is and how you get there, because that's a question I'm getting a lot right now. I have a lot of people that would love to invest in the fund, but they're not yet accredited. And I can't really talk about what's upcoming, but I can tell you we have another great opportunity that's going to be coming up soon. So just keep that in the back of your mind. But before I begin, this is not an offer to sell or a solicitation of an offer to purchase securities. This offer is only made through the PPM. The strategies mentioned in this presentation may not be appropriate for everyone. Always consult your personal tax advisor and/or attorney to discuss your specific situation. Past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. While every effort is made to maintain accurate and current information, the possibility of errors and/or updates always exists. So let's talk about what accredited investors are, because this is really the question. There are 3 real ways to become an accredited investor, and then there's some loophole ways that you can get that status too. So number 1, the easiest one is a net worth over $1 million. This is where we talk about having more property and having more assets is going to help you have access to more things. So at the end of the day, you have to look at what is your total net worth. Now, net worth can be very subjective too, because some of you own businesses and your businesses have worths. You might own art, jewelry, other things that have worth, stocks, bonds. So there's lots of ways, life insurance, cash life insurance policies. So there are ways to find out how much you can get all of that to compound to. And there's a few ways you can do that, right? You can talk to your CPA and have them write a letter. Some CPAs don't like to do that. And so you can go to a place like Verify Investor to find out if you qualify. But number 1, it's a net worth over $1 million, and that has to exclude your primary home. So this goes back to what I talk about. That equity in your primary home is doing you no benefit. Whether you're trying to get an accredited status or whether you just want to go buy more property and work towards real estate professional status, that equity is doing you no good. It's cheap to borrow against. You can make more money on your money if you do it right than what it actually is going to cost you to go borrow that money. So this old, kind of own everything in cash mentality is doing none of us any benefits. You still want to be safe. You still want to be smart, but you also want to use what you have to make you money. That is the goal. So that's step 1. That's one way you can be an accredited investor. Number 2 is if you have income over $200,000 a year personally, or if you have a spouse or a partner over $300,000 a year. Now that has to be each of the prior 2 years, and that has to mean that you are expecting reasonably the same to continue. Also, you can have a certain investment professional status with certain licenses. And so I've included these below. Now, I had someone ask me, well, what if I take out a HELOC and I take that cash out and I let it season? Well, now that's my cash. Now that's my net worth. The answer is there are lots of ways to become accredited with seasoning. So start thinking about that now. If your goal is to build a portfolio, your goal is to have money to use, whether you're seasoning it so that you can use it for down payments on loans, or whether you're seasoning it to try to be able to become an accredited investor, you can do that path now. And if our specific fund is one that you're interested in, we have all the way through November for raising. And so there is still time for you to do things to get to that status if you want to invest. So what we are doing with our fund is buying 1 to 4 unit properties, renovating with high-end finishes, leasing to professionals in these growing high-value markets that we love, like Grayson County. We're targeting a return of 8% yearly. That is a cash purchase target. Our plan is to go refinance and do these in leveraging, which means the return goes up, but we want to be really conservative in light of what's going on right now. And then our time frame is a 3 to 7 year hold. Anything we sell after year 3 will be capital payback, meaning the investors will be paid back. Anything bought and sold before year 3 will be used to buy more property. Now, one thing to keep in mind about our fund is that we are doing 100% investor capital payback before we take any distributions. And so you're getting paid back before we get paid. So it's diversified because we're doing multiple rental properties. We're looking for current cash flow and long-term appreciation. We're targeting these high growth markets. We're streamlining the vertical integration of the operations because I have this primary business that can oversee paying a lot of the bills, doing the property management, all those things, so we're not having to go hire employees. Access to significant deal flow because of who we are and what we do, Michael and I personally, with our rehab investment journey. And then, as I mentioned, we're buying everything in cash in the first year, and then as soon as rates allow, our plan is to go refinance. The minimum investment into the fund is $25,000. It's 50 units, but we're taking half units. The total maximum offering is 20 million. And then again, the offering close date is 9 months with a 3-month extension. So that's November. And again, this one is accredited investors only. Very few funds are taking or truly open to all unaccredited investors. They're just much more expensive, much more difficult. So we're doing some new homes, previously renovated, properties needing renovation, predominantly single family homes or small multifamily buildings. Our average price point of homes all in is less than 160,000. So absolutely incredible numbers here. We're creating built-in equity year 1 by acquiring discounted properties in these areas, renovating to high standards and leasing to professionals. To put it into perspective for you, we have 322 renovated homes that we're in for 160 approximate. So again, I can't speak to exactly how much equity there is. I can tell you that we have had amazing success in what properties we've been acquiring, and we're very excited for what we've put in this fund. And the vast majority of it is in this Grayson County area that we love what's happening up there with chip manufacturing. And those of you who haven't heard, I haven't done a market update, but now Texas is trying to do their own bill to mirror the Senate bill to get even more chip manufacturing going on. So lots of incredible things happening right now on top of the enterprise fund stuff happening right now in Grayson County. So if you're not looking at Grayson County, I strongly recommend you do. Now there'll be quarterly distributions, and that'll be once stabilized. And then given the extraordinary growth in the area, we believe they're going to be growing in value over the next 3 to 7 years. And we also believe they already have value over what we've paid. We've closed 15 properties. We have 3 closing today and Monday. Right now we've got 9 single family in Sherman, a duplex in Sherman, single family in Gainesville, single family in Greenville, single family in Farmersville, and 5 in Denison. Once we have enough money to go buy another, we're going immediately. Again, we have tons of inventory. So for me, this is very easy with these wholesale properties. This is an example of one of the duplexes that we bought. This was in the low 200s, 2-bedroom, 1-bathroom per unit, renovated. Awesome property. Actually already raised rents on that one. And some more examples of some of these properties that we've bought. These are Sherman and Denison. Awesome, awesome brick homes, most with garages. If you want to learn more or you're ready to invest, you can go to our website, growdevelopments.com, and look at the North Dallas Rental Fund. Now let's talk about active investing. And this is where most people get started. And this is how we help you get to accredited investor status. This is where we follow our 2 to 6 year model. Now, the fund is following that same model, right? The only difference is instead of 1031 exchanging, we are using that equity to capital payback to our investors as profit. But the strategy is the same. So on the OmniKey side, we are helping you buy properties where you own them. You manage them in terms of watching what the market's doing, making the decisions on what you want to do when you want to sell, and we hold your hand and we guide you. So we take care of helping you buy. We take care of the property management. We take care of helping you sell. We liaison and work with the 1031 exchange company, help you go buy more, and follow that life cycle of the property that we talked about. And again, that model is every 2 to 6 years dependent on a few things, how much the expenses go up, how much the rents go up. That's how we determine when it's time to sell relative to how much the appreciation has continued. And we follow this model through North Texas and Southern Oklahoma. So we have amazing opportunities. We have this investor portal. If you have not registered for that, you can reach out and we can get you set up. And we do flyer blasts every single day. We work with over 20 builders. We have an average inventory of over 50 homes available at a time. And we work with 6 lenders on unique programs to help you on your investment journey for your active investing. So again, how does this work? We work as your agent. We are the buyer's agent. We represent you. We have no relationship with nor representation over the seller. We are quite literally your agent, and the seller pays us to do that. We bring abundant off-market properties to you, but we also scout on-market opportunities. So we are bringing you the best of everything we can find out there. We do mostly new construction properties for a more passive feel and more control over expenses. And all of these needs are under one roof: the property management, the acquisitions, and the sales. And then we handhold to liaison with 1031 and finance. Our team specializes in working with investors at all levels, whether you're just getting started out or whether you already have a portfolio you want us to assess and take under our wing, because again, that life cycle of a property remains consistent throughout your journey, so you can join us at any phase of that journey. The first thing we do is a consultation to discuss your goals and your current situation. Next, you'll receive access to our exclusive portal and start getting those flyers every day. Once you select a property, we're going to act as your agent and coordinate and facilitate the contract and everything that you need to do with you. And then once you purchase, you'll immediately transition to our property management team, where we continue watching the property under our model and make recommendations for you when it's time to 1031 and double, or look at potentially a cash out. But typically that doesn't make sense. Typically the 1031 is the better call, because value goes up, rent goes up at a lower rate, your expenses go up, taxes go up, insurance goes up, and so the return would still be too low to do a refinance. So again, depends on where you are in your investment journey. So you can book a call with our investment team here, or you can always email them at investments@omnikeytexas.com. Or if you're wanting to set up a consultation with me, you can always reach out to me directly. So I've brought just a few of our off-market inventory today. As always, we have a ton, just gonna give you a few. So this is a new construction duplex in Denison, completed in August, so great timing. 3 2.5 per side, almost 1,300 square feet per side, and that's at $440. Awesome layout on these. We are seeing rents go up in these areas. We're still being quite conservative, but if you've been watching the market, you're seeing that rates are going up, and inventory is crazy right now. It's really kind of changed back overnight. Exactly what we were expecting would happen. I actually listed my primary home that I'm selling because we're building on our land. If you're coming to the mastermind, you're actually going to get to see our estate and our ranch and our animals and greenhouse and all that. But anyway, I put it up on the market expecting it was going to take a while because of the price point. We've had a dozen showings and I have 2 offers coming. So the market is definitely going crazy again. But again, it goes back to supply and demand, right? There's literally no inventory. If you look back at the crash nationwide, we had something like 4 million homes on the market going into the crash, and right now there's less than 1 million. So inventory wise, we're just astronomically low. And you look at North Texas, for every 5 jobs, we're building 1 home. So we've got a real problem here. We can joke and laugh about it, but it's going to be a crisis that my kids and your kids, if you're local, are going to have to deal with. But as investors, it's great. And so we're excited to see what's happening there. But single family in Greenville, 3-bedroom, 2-bathroom, 1-car garage, just over 1,060 square feet. This one is almost done. It'll be finished in July. This one is another new construction, 321, little larger, almost 1,300 square feet, also July. This one's 235. This one's 240. This has a full 2-car garage. And we build the same properties over and over. And so keep in mind that this one might have some different colors and things. So when you reach out to our team, they can tell you exactly what the one you're looking at is going to look like. In many of these, we have more than one available as well. So 322, just over 1,250 square feet for 240. And then this is our Oklahoma subdivision. And this is right over the border, half-acre lots, 3-bedroom, 2-bathroom, 1-car garage, just over 1,230 square feet, brand new construction for 229.5. So I appreciate you guys watching. Let me look at some questions here. Okay, Question number 1, during the webinar, can you answer the following? Does it make sense to take loans to purchase rather than 1031 directly into a new property, i.e. pay in full if you're over 65? Okay, so that didn't go well, did it? Let me get back into my slide here. Yeah, so for those of you that have kids, you probably already know that when you have them set as an emergency override, it pops right up no matter what you do, but you have kids in college, you do that. So anyway, does it make sense to take loans? So here's the negative. You really can't pay cash because you have your reinvestment goal. And so no matter what you do, you have a home, let's say you bought it at 150 and you sell it at 275. It's going to be pretty impossible to find a new property at your sales price minus closing costs because you have what's called an identification goal or a reinvestment goal, meaning that you have to spend whatever that cost is that you owe to spend. So if you sell a home using round numbers, say you sell it for 300, you have 5,000 in closing costs. You have to identify 295,000. The odds of you making those numbers work perfectly are very, very difficult. In addition to that, again, you're losing 4 to 5 times what you could be doing if you are leveraging. You are never going to hear me say, no matter what age you are, to pay cash for a property. The only time that cash is something that makes sense is if you have no other option, if you don't qualify for financing, if you can't get a loan. But most DSCR financing, they don't qualify you. They qualify the property and its cash flow, and all you need is a good credit score. So again, there is almost always an option to be able to leverage, but it doesn't matter how old you are, guys. Like I told you, I have clients in their 90s that are still investing. Let's see, can you talk about the specific benefits of owning more property from a lender's perspective terms to the investor? Absolutely. So most direct bank lending, like what I do today, they will not lend to someone who's not an experienced investor. They want to see you treating it like a business because they hold their own loans. So when you do a Fannie Mae loan, that loan is going to be sold and then serviced by someone. So whoever you go through, they're not keeping that loan. So they don't really care what happens to it. A direct bank like who I go through, they keep their loans, they service their loans. So they want to write these loans to people that are professionals. And then of course, when you get into a position where you're doing things like loan to cost lending, like I talked about, or more advantageous terms, that is going to be reserved for their clients, for their relationships, old school handshake business, which is how Michael and I have gotten to where we are and why we introduce you to those same contacts to help you build your portfolio. So there are lots of benefits to becoming a true investor and running it like a business. And a lot of it's about access. It's about access and the banks feeling confident in who you are and what you can do. Let's see. There's someone talking about that they found a credit union offering 100% financing at 8.75%. You'll be cash flow negative, so I'm not going to spend too much time talking about that. Anytime you get up to a rate in the 8s, your cash flow negative makes no sense. You'll have to put so much money down. So even though they might have a program that could be 100% at 8.75, there'd be no property that would qualify. So I would never recommend someone leverage more than 80%. That's just asking for a disaster. There's a reason why Texas limits cash outs to 80%. That is how we keep our market safe. That is how we make sure that people have equity and a stake in their home. I'll never forget back when I was doing BPOs and short sales back in the day and all these flat fee listings, I had a lady call me who wanted me to short sell her home. We were doing dozens of them at a time. And the reason that she wanted to short sell is she was in that house for no money down and her AC broke and she didn't want to spend the $1,400 to fix it. That's the type of thing that we created back in 07 that I don't think we're ever going to allow to happen that way again. And it's because people did not have meat on the bone. They didn't have skin in the game. And so that's how we wound up where we wound up. And that's why all of us are out here saying this is nothing like what that was. And that was before we were into the housing shortage that we have right now. All right, so how do you decide when to refi cash out versus 1031 exchange, especially when refi still covers expenses? So the goal is not to cover expenses. The goal is to have the highest cash on cash return you can. And I just taught a class on this last week. And so if you didn't watch that class, go watch that class and then reach out and we can talk about that more. But long story short, once the value gets to a certain level, the rents do not keep up, but the expenses continue to rise. It no longer makes sense. Cheapest property you can be in makes the most sense. I'm not sure what if a group of investors under one company also invests in your fund. I'm not sure what you're asking. Send me an email and I can answer that more in depth. If you're asking if a group of people or a company can invest in the fund, the answer is yes. It doesn't have to be an individual. What are your thoughts on solo 401k investing in a single family homes? Rates around 8% with 40 to 50 down. We've been doing IRA lending for a long time. Jason Zook has been our contact at NASB for years. He just left and he went to a different department. He didn't leave. I think he'd been with us for like 12 years, but there's a new contact there. Absolutely. I don't know what else you're going to do with your 401k that's going to offer the safety of what real estate can, in my opinion. That said, rates are higher with that right now, but you should not be seeing 40 to 50% down. Actually, the IRA lending companies prefer new construction and they give advantageous and more beneficial terms for new construction, in my experience, than what they do with pre-owned. And so if that's something that you're interested in, reach out to the team and we can make connections and introductions from there. Let's see. I want to learn more about the North Texas market, so I'm coming to the event in April and I'm taking the property tour. What recommendations do you have for me to maximize my time while there? My goal is to invest in a single family soon. You know, it depends on how long you're going to be here for. Our events are packed and we move quick. Anyone, if you've listened to me talk, you know I talk a lot and we pack a lot of information in everything we do. Probably not one of my best qualities, but you're never going to leave a webinar or an event not learning a lot. I would recommend you talk to other people. We have mingling and mixing time that's coming in. I definitely recommend you come to the after party. The mastermind obviously is something that is, you can't replicate that like this. You can't get a group of 10 or 12 highly motivated people, some just getting started out, some way further along in their journey, and be able to sit down with like Michael and I or other people like that for an entire day and take away the same amount of information with anything else. We're going to be doing more masterminds. We've had a lot of interest in that. I've had a lot of people ask me to do them in evenings and also do them on a Saturday. So we're going to be offering a lot more opportunities for those one-on-ones, and that's why we started doing the consulting calls. The form that we use is very in-depth. So you're going to put every bit of information, every property you owe. We're going to calculate what your return was at entry, what your return is today, and make recommendations property by property. And so, you know, I would make sure that you're visiting these areas, which if you're coming on the tour, you're going to get to see all of our top areas, and come to the event. The education that's being offered on Friday is unparalleled. I assure you. I think it's like 500 slides that we're hitting on, guys. It's a massive amount of information. And so I really recommend that you come to that and you learn what you can from that. Obviously, not everyone can travel here, which is why we do these little classes and why we do the small masterminds. And we'll probably put on a virtual mastermind because we have a lot of international clients too that have been asking. But at the end of the day, learn the market, learn the model, learn how to get started with where you are. And that's the benefit of a mastermind, right? That's the benefit of these consultations. And my team is wonderful. You can talk to them and they're going to help you. But if you're looking for me, where I'm going to look at is, where are you working? What are you earning? What are your debts? What do you currently own? What are your goals and why are you wanting to do this? And draw a path, a map for you to follow, personalized to your situation. So that's what those 30-minute consultation calls are. That's the goal of the mastermind. And we're actually not doing the included consultation until after you've attended the mastermind, and we're going to ask you to fill that information back out, make updates after you've completed the mastermind, so that you really have an idea what it is you want, where you're leaning, what you're feeling, and you are armed with the right information to be able to tell us what we need to know to guide you on that journey. That's going to be the biggest thing. It's about where to start and how to grow. I can't tell you how many people have access to a lot more capital and opportunity than what they think, because they only think about, oh, I've got 50,000 in the bank, but they don't think about all the other things they have access to: a 401k, cash life insurance, equity in home, equity in vehicles. There's so many different ways to pull capital, to invest, to make more money than what it costs you to borrow. And that is where so many people go wrong and slow down and don't get to the point they need to get to. What are my thoughts on seller financing? Absolutely not. Absolutely not. Seller financing sub 2, it's too risky, guys. The whole point of everything we do is to be as risk intense, away from those types of programs, those types of just models. There's such a great way to do things easily and as passive as you can get, or go fully passive without having to take risks. Why would I want to piggyback on someone else having to do something for me to make my money? And the great thing about leases is that if a tenant doesn't pay, you just get them out. If the property needs to be re-rented, you put it back on the market, you get it re-rented. You go into seller financing or where somebody else has a note and you're doing sub 2, you are beholden to somebody else being honest, somebody else being on top of their business, on top of their things that they need to do for you to succeed. You don't ever want to put your eggs in somebody else's basket to make you money, and you don't want to do things that you can't control. Again, you want to be in control of your own destiny and your own investment journey. That is how you make sure it goes well. The minute that it's out of your hands, the minute that you start dabbling in some of these other get rich quick type things that are out there, that's where I see people fail. Again, everyone has a different model. What I believe in, what works for me may not be what's best for you, but you will not see me up here talking sub 2, seller financing, lease purchase, lease option to purchase, none of it, because I don't believe in it. It's not how I got where I am. I stick to what I know. I preach what's worked, and that is exactly what we are all about. So with that, I thank everyone for sticking it out with me for more than an hour. We are so thankful to have all of you on this journey with us. We're always here if you need anything, and I truly hope to see you guys, if nothing else, at our mixer on Friday night. We've got awesome event coming and hope to see you there. Everyone have a wonderful weekend. Stay safe, and I'll see you next week.